The U.S. Federal Reserve has cut rates again, its second easing move this year, while the Bangko Sentral ng Pilipinas has lowered policy rates by 175 basis points since August of 2024. Yields on local government securities continue to ease even as investor sentiment remains guarded amid peso weakness and governance risks. Yet, despite the uncertainties, many analysts say that this is one of the few markets with real clarity that bond yields are headed lower as most of the risk premium from corruption and currency fears is already priced in. Joining us now is Dino Aquino, the Vice President and Head of Fixed Income at Securities Bank, his outlook on the local bond market. Hi, Dino. Thanks for being here with us.
Happy Halloween, Mikey.
Yeah, happy Halloween.
Spooky markets.
Spooky, yes.
Yeah.
PSEI down 9% year to date, but the bond market, that's what we're here to talk about. That's doing well against all local asset classes. The peso, the PSEI, with returns at about 3 to 4% for both short and long-term tenors. But let's hear it from you. How's the bond market doing right now?
Well, it's underperforming versus previous easing cycles. Basically, because as you mentioned,
Could have been more.
Could have been more, right? Because you mentioned on the noise with regards to the politics, and of course the weakness of the peso and the PSEI is spilling over. Some of the risks are spilling over.
How much of that? I mean, you know, the corruption allegations, that all that noise, that political noise, has increased our risk premium. By how much would you say? How much has it dented, demand?
Well, the bond market is underperforming by 30 to 40 basis points, based on historical averages. Just to give you an idea, the spread between the benchmark rates and the 10 years around 50 to 75. So we're at 4.75 right now. So if you look at it in perspective, the 10 year should be trading at around 5.5, at least. Right? But it's trading at around 5.9. So it's underperforming based on historical averages by around 40 basis points. So because of all the risks that you mentioned, it's already embedded on the price already.
So all of that is baked into the cake.
Yeah.
Okay. So that said, what's your outlook for the bond market, factoring in the recent rate cut, the second rate cut by the U.S. Fed, which was supposed to be dovish but a little hawkish because he
took
December out.
Yeah, he took December out, and
right?
Trump's not going to be happy with that anyway. I think I have one word to describe the market right now. It's just chaos. But in the bond market, it's organized chaos. Because if you look at the direction in terms of the currency and the stock market, there's really no direction. There's so much uncertainty when it comes to where it will go next year, well into 2026, how will it end in 2025. But if you look at the general trend in the bond market, it's on a downtrend in terms of rates. It's not just moving lower than we hoped for, but the downtrend is intact. So it's more of an organized chaos. Of course, there's chaos, there's volatility, but at least the clarity is there. So again, if you put a gun to my head and ask me what asset class I'm going to buy, I'm not sounding biased because it's the bond, it's an asset I trade, but I'll go with the bond market right now.
Okay. Yeah. Speaking of the currency, the swings, although incrementally maybe it seems low, they're pretty wild if you look at it, from a volatility standpoint, because this is what is keeping people back. How do you think the currency swing is hovering about at 59? How do you think that's affecting everything?
Actually, the bond market volatility heightened the past 2 to 3 days as the currency became really volatile. I think it was Wednesday. It hit around 59.20, 59.21. And then it closed at 58.60. So in the morning, the market was selling, and then in the afternoon, the bond market was buying it again. So they're actually moving in line with how the currency is performing also.
Which is hard. It's hard to attract foreign investors with these swings because everybody likes stability. And here in the Philippines, we're expensive, we're risky, and we're volatile also because of the currency. That makes it hard, especially as the Treasury wants to lift the foreign ownership cap on peso bonds to 10% as the Philippines moves closer to being included in JP Morgan's emerging bond index. How transformative could this be for liquidity and inflows?
We're already on the watch list. So that's a first step that we are part of it already. So we have 6 to 9 months relatively in terms of inclusion to be included. So if they lift that to 10% and we find some stability in the currency, then those inflows would come in and it will provide a better sentiment for the market.
Yeah, that's going to lift sentiment for the market. Now, inflation. Inflation remains well within target, but the peso has been under pressure. What's your outlook for everything, given that, the GDP outlook, the risks are to the downside because we essentially have no growth drivers.
Yeah, there's no growth drivers because of the canceled projects with the DPWH and all, because of the ongoing investigations. And I think consumer spending is also quite low. If you look at the car sales, I don't have the exact figure, but it's also low compared to last year. So there's really no growth driver. So the risk on the GDP is already tilted on the downside. Inflation, I think, would remain benign. Our house call is around our house call is around 1.9, but personally, I'm looking at around 1.6. But again, those are just
well within the government's target.
Well within the target and below the target. So that would provide them further ammunition to ease and help the economy grow with the GDP tilting on the downside.
Yeah, that's right. Speaking of GDP, what's your outlook for 2025? The government has a 5.5 to 6.5% target. Everybody is just trying to catch up to the lower end of that. What are your thoughts on
It's
GDP?
tough to reach that target, if you ask me. Even Governor Remolona echoed that the 2026, he's mentioning that 2026 could average around 5.3. So it's still at low 5. So he's just looking at 2027 for the uptick in GDP. So that could mean that the BSP would remain accommodative well into next year.
Well into next year. So are you saying, are you expecting a rate cut in December?
Yeah, and more cuts in
And
2026.
beyond?
Yeah.
So what's that looking? What does that look like for you?
So probably a terminal rate of around 4% for the benchmark rates, 4% or even low
now.
3.75 if
Yeah.
GDP does surprise on the downside.
And we want to get your read on the economy right now. All things taken into consideration. What does that macro picture look like for you?
Actually, the macro picture is still very much good. Even if we say, for example, we print a GDP number in the third quarter of around 5%, we're just still the second best performing ASEAN in ASEAN next to Vietnam, because Vietnam is, well, they're doing awesome at, I think, 8% GDP. So we're still second compared to our peers. But I guess given that it's an election year, we would have hoped for
expected more.
hope for more growth. But again, given the lack of
lots
growth,
of headwinds externally
headwinds,
and locally.
growth drivers. So there's still risks on that side.
Okay, but where are the opportunities now? Is it in the 15 to 20 year tenors?
I actually like the 15 to 20 year tenors. If you look at the curve, entire bond curve, the rally happened. The rally actually is in the 2 to 10 year. So there's no gains realized in the 15 to 20 year. If GDP does surprise to the downside, well, hopefully not. But if it does, then the 15 to 20 year tenor will be the ones that will perform best. The yield curve would really flatten, because on a market that shows slow growth, the yield curve generally flattens.
Okay, all right. Thank you so much for your time this morning, Dino Aquino, the head of fixed income at Securities Bank.